The first sign that something is breaking is never the collapse itself but the silence that comes just before it, when systems that once moved with confidence begin to hesitate, when policymakers speak more often yet explain less, and when the public senses pressure without being able to name its source. Throughout history, this moment has always arrived disguised as normalcy, as markets still function, currencies still circulate, and institutions still insist that control remains firmly in hand, even as the underlying structure begins to fracture under its own accumulated weight. Every great financial ending has shared this same opening act, a period when debt no longer fuels growth but merely sustains appearances. When borrowing stops being a bridge to the future and becomes a wall against the past, and when the mechanisms designed to stabilize economies quietly transform into tools for postponement. What we are living through now is not unprecedented, but it is rare because it represents the late stage of a cycle that has defined empires, destroyed currencies, and reshaped global power more times than most histories are willing to admit. The danger is not that the system will suddenly collapse overnight, but that it will continue forward in a weakened state, forcing governments, banks, and households into decisions that narrow future options and accelerate an outcome that once seemed distant. The debt game has always ended the same way, not with a single dramatic event, but with a slow realization that the rules have changed and that the promises underpinning the system can no longer all be kept. To understand why this moment matters now, it is necessary to look beyond headlines and quarterly data and instead examine the scale and structure of global debt as it exists today. Public debt levels across advanced economies have reached heights previously seen only during total war, while private debt, corporate leverage, and financial sector exposure have expanded alongside increasingly complex instruments designed to distribute risk without eliminating it. Central banks have responded to successive crises by lowering interest rates, expanding balance sheets, and redefining what was once considered extraordinary policy into routine intervention, creating an environment where debt appears manageable only because the cost of carrying it has been artificially suppressed. This arrangement works only as long as confidence remains intact, inflation stays contained, and growth continues at a pace sufficient to service past obligations, but history shows that these conditions rarely coexist indefinitely. When inflation rises, interest rates must follow. When rates rise, debt servicing costs escalate, and when servicing costs escalate, political and social pressures emerge that force difficult choices between stability and solvency. The present moment is defined by this tension, as governments face aging populations, slowing productivity growth, and geopolitical fragmentation, all while attempting to sustain debt loads accumulated during decades of expansionary policy. The stakes extend far beyond balance sheets, because debt is not merely a financial instrument, but a political and social contract that binds future income to past decisions. When that contract becomes strained, trust in institutions erodes, currencies weaken, and the legitimacy of the system itself comes into question. This is why debt crises have so often coincided with broader periods of upheaval, from revolutions to wars to the collapse of entire political orders. History provides a clear lens through which to view this pattern, beginning with some of the most well-documented economic breakdowns of the modern era. In the aftermath of the First World War, Germany faced reparations obligations that far exceeded its capacity to pay through normal fiscal means, leading the government to rely increasingly on monetary expansion to meet its commitments. The result was the Weimar hyperinflation, a period during which the currency collapsed, savings were wiped out, and social stability disintegrated, demonstrating how excessive debt combined with constrained policy options can destroy not only an economy but the social fabric that sustains it. Across the Atlantic, the United States experienced a different but related dynamic during the Great Depression, where a buildup of private debt during the 1920s collided with a sudden contraction in credit, triggering mass defaults, bank failures, and a collapse in demand. The response, documented extensively in Federal Reserve archives and later analyzed by institutions such as the IMF and World Bank, involved unprecedented government intervention, debt restructuring, and monetary expansion, setting a precedent for modern crisis management while also embedding a long-term reliance on debt-driven stabilization. Following the Second World War, a new global financial architecture emerged centered on the Bretton Woods system, which linked currencies to the US dollar and the dollar to gold, creating a framework intended to prevent the competitive devaluations and debt spirals that had destabilized the interwar period. For a time, this system supported rapid growth and relative stability, but as U.S. deficits expanded during the Vietnam War and domestic spending programs increased, the gold backing became unsustainable, leading to the collapse of Bretton Woods in 1971 and the transition to a fully fiat monetary system. This shift fundamentally altered the nature of debt, removing the external constraint imposed by gold and granting governments far greater flexibility in issuing currency and accumulating obligations. While this flexibility allowed for more aggressive responses to economic downturns, it also enabled debt to grow faster than underlying economic output, a divergence that has become increasingly pronounced over subsequent decades. Institutions such as the Bank for International Settlements have repeatedly warned about this imbalance, highlighting how prolonged periods of low interest rates encourage leverage and risk-taking that amplify vulnerabilities rather than resolve them. As financial markets globalized, debt became more interconnected, with capital flowing freely across borders and tying national economies together in complex webs of obligation. Sovereign debt crises in Latin America during the 1980s, Asia in the late 1990s, and Europe following the global financial crisis each revealed different facets of the same underlying issue. Namely that when debt grows faster than income, adjustment eventually becomes unavoidable, whether through default, inflation, restructuring, or external intervention. The global financial crisis of 2008 marked a critical inflection point, as private sector excesses were absorbed onto public balance sheets in order to prevent systemic collapse. Central banks deployed extraordinary measures, including quantitative easing and emergency lending facilities, stabilizing markets but also normalizing policies that blurred the line between monetary and fiscal action. While these measures succeeded in averting immediate disaster, they also entrenched a dependency on cheap credit that has proven difficult to unwind. In the years that followed, debt levels continued to rise, driven by demographic pressures, infrastructure needs, and repeated economic shocks, culminating in massive fiscal and monetary responses to the COVID-19 pandemic. According to IMF data, global debt surged to levels not seen since the Second World War, while central bank balance sheets expanded at an unprecedented pace, reinforcing the perception that there were few practical limits left to borrowing. Yet limits have a way of reasserting themselves, often through channels that policymakers least expect, and the return of inflation in the early 2020s served as a reminder that monetary expansion is not without consequence. As price pressures intensified, central banks were forced to reverse course, raising interest rates into an environment saturated with debt, exposing vulnerabilities that had been masked by years of accommodative policy. This is where the mechanics of the debt game become most visible, because debt sustainability depends not only on the absolute level of obligations, but on the relationship between interest rates, growth, and political capacity. When growth outpaces interest costs, debt ratios can stabilize or decline, but when rates rise faster than growth, the burden compounds, forcing governments to choose between austerity, inflation, or financial repression, each with profound social and economic implications. Today, the same historical forces are converging once again. As geopolitical fragmentation disrupts trade, energy transitions require massive investment, and demographic shifts strain public finances, all while the global monetary system remains anchored to a handful of reserve currencies whose issuers carry some of the world's largest debt loads. Sanctions regimes, reserve diversification, and discussions around alternative settlement mechanisms reflect growing unease with the existing order, signaling that confidence, while still present, is no longer in question. Behind the scenes, institutions such as central banks, treasuries, and multilateral lenders are navigating a narrowing corridor of options, attempting to manage inflation without triggering recession, to support growth without fueling bubbles, and to maintain credibility while acknowledging constraints. This is not a conspiracy, but an incentive structure shaped by political realities, electoral cycles, and the imperative to avoid immediate crisis, even if doing so increases long-term risk. As the cycle accelerates, warning signs multiply, including rising debt servicing costs, increased reliance on short-term financing, and growing social resistance to fiscal adjustment. Echoing patterns observed in previous late-stage debt cycles documented by economic historians and policy analysts alike. The question is no longer whether adjustment will occur, but how it will unfold and who will bear its costs. At the climax of every debt story lies a simple truth that is often obscured by complexity. namely that debt is a claim on future resources, and when too many claims accumulate relative to what an economy can produce, resolution becomes inevitable. This resolution does not always arrive through collapse, but it always involves a redistribution of wealth, power, and expectations, reshaping the system in ways that only become clear in retrospect. We stand now at a point where the accumulated decisions of decades are converging, where the tools that once postponed reckoning are losing effectiveness, and where the narratives that sustain confidence are being tested by material constraints. History does not repeat exactly, but it does rhyme, and the rhyme we are hearing today has echoed through the fall of empires, the restructuring of currencies, and the reordering of global power before. The debt game is almost over, not because the system will suddenly disappear, but because the conditions that allowed it to expand without consequence are fading, forcing a transition that will define the next era of economic history in ways that few fully grasp yet. And as this transition unfolds, the choices made now will determine whether the ending is managed, chaotic, or something in between, a question that remains unanswered as the story continues.